Welcome to the pit. I'm Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's Elite Investors get 0-day access link in the description. Now let's get into today's numbers. We are staring at a market that is addicted to adjusted figures where companies are calling their debt equity just to keep the banks happy. But accounting acrobatics won't save you when the risk-free rate is climbing to 1.47% and refinancing math is getting brutally tight. Today, we expose the difference between a true sanctuary and a yield trap before the window closes. Looking at the broader market, the Straits Times Index closed near 4,985 yesterday, knocking loudly on that psychological 5,000 door. It looks like a recovery from the outside, but under the hood, the reality is shifting. The refinancing math for Singapore's heavy hitters is getting noticeably tighter. We are seeing the risk-free rate climb to 1.47%. When the baseline cost of capital goes up, the pressure on heavily indebted companies compounds instantly. And let's be honest, the window to act on this data closes incredibly fast. In this current market environment, the difference between finding a true sanctuary and walking into a yield trap is often decided in a single trading session. By the time the mainstream news picks up on these forensic shifts, the optimal entry or exit window has usually already opened and closed. You need to see the setup while it is live. That is exactly why Iggy's Elite Investors do not wait for the free weekly wrap-up. They get the full 0-day forensic breakdowns and the red zone watch list the moment the numbers hit the terminal. For 9 Singapore dollars a month, which is literally less than a kopi and kaya toast set at Raffles Place, you get institutional grade cheat sheets. You stop being the exit liquidity for the big funds and start thinking like the forensic analyst. Let us look at the market snapshot for the 9th of April 2026. The volume is screaming recovery, with March securities turnover hitting a staggering 52.8 billion Singapore dollars. That is a 78% year-on-year surge, pushing daily average value to 2.4 billion. It is a decade high volume. But the regional indices have not read the script yet. The Hang Seng confirmed at 25,752. And while there is a recovery impulse following the US and Iran ceasefire, regional volatility remains the primary watchword. Moving into our first forensic audit, we are looking at City Developments. The headline here is a gearing alert. They just launched a 2 billion Singapore dollar multi-currency perpetual securities program. The table shows net gearing sitting at 70%, which fails my 35% standard. The forward asset yield is 2.8%, failing the 4.7% hurdle. The verdict is clear. A 2 billion Singapore dollar safety net made of paper will not stop the gearing gravity. Let us run this through the 5-layer audit. That 70% net gearing is exactly double the Iggy 35% safety ceiling, and it sits well above their own historical 60% comfort zone. While peers like CapitaLand Investment continue moving toward an asset-light model with lower balance sheet intensity, this company remains heavy on land bank and heavy on debt. If we see a 10% spike in interest costs on this 2 billion pile, driven by SORA volatility, their interest coverage ratio will be crushed toward the 3 times danger zone. If you are a 45-year-old HDB owner in Bedok relying on these dividends, remember that perpetual coupons must be paid before your common dividends. This brings us to my forensic stance, which is a firm watchlist trigger. This 2 billion Singapore dollar perpetual program is being sold as financial engineering, but I call it debt with a better suit on. When your gearing sits at 70% and your forward yield barely clears 2.8%, you are paying a premium price for a balance sheet that is still doing heavy lifting on borrowed time. The debt wall does not care what you call the instrument. My monitoring threshold has not been crossed for accumulation. It has been crossed as a caution flag. Equity optics do not pay the interest bills. Our second audit focuses on the Singapore Exchange itself, and this is a yield trap alert. The current yield is hovering around 2.3%, which outright fails my 4.7% standard. They confirmed a record high March turnover of 52.8 billion Singapore dollars. The house is absolutely winning right now, but the shareholders are only getting breadcrumbs in return. Running SGX through the 5 layers, the fundamental problem is that a 2.3% yield offers almost zero risk premium over the 4.0% CPF special account benchmark. Local banks are providing twice the yield with comparable fortress status, making the exchange look like a very expensive growth stock. If we see a 10% retreat in global trading volumes due to cooling US and China trade tensions, that earnings momentum will stall, leaving that tiny 2.3% yield as your only support. For a 60-year-old retiree in Jurong managing an SRS drawdown, this so-called sanctuary is actually a storage locker. It keeps the capital safe, but it does not grow the groceries. My forensic stance here is that this is a classic yield trap. SGX is one of Singapore's most respected institutions, And that reputation is exactly what makes it a yield trap for the income investor who is not paying attention. A 2.3% yield against a 4.0% CPF special account benchmark means you are taking on equity volatility for a return that does not even beat your savings floor. The March volume surge is real and impressive, but volume is the exchange's income, not yours. Track it, but do not anchor to it. Growth is the story, but the income is a footnote. Our third audit tackles Olam Group. This is another serious gearing alert. The headline gearing for the first half of fiscal year 25 is 2.83 times, completely failing the 0.35 times standard. Even the adjusted gearing of 0.58 times fails the test. With an estimated net debt of around 19 billion Singapore dollars, the verdict is that we are seeing new captains taking over, but they are dealing with the exact same leaky balance sheet. Looking at the 5 layers for Olam, the raw fact is that Chairman Lim Adu and Group CEO Sunny Verghese are stepping down after the 27th of April 2026 annual general meeting. But that 2.83 times headline gearing is nearly 8 times the Iggy ceiling. The adjusted 0.58 figure is pure Copitium logic, discounting unsold inventory to make the debt look smaller. While peers like Wilmar maintain a predictable debt trajectory, that 19 billion Singapore dollar net debt is a heavy anchor. A 10% credit squeeze could force aggressive asset fire sales to meet the debt wall. If you are drawing CPF life payouts in Toa Payoh, this is a strict wait and see. New leadership is good, but they inherit a red zone balance sheet. This keeps the stock firmly as a watch list trigger. Leadership changes here are overdue and arguably positive, but succession is a narrative, not a balance sheet repair. Headline gearing of 2.83 times tells you the new captains are inheriting a vessel that is already riding low in the water. The adjusted 0.58 times figure is the number management wants you to remember. My job is to make sure you remember both. Until the debt wall refinancing risk is visibly de-risked under the new management, this stays firmly in watch and wait territory. Succession plans do not settle multi-billion dollar debts. Alright, favor to ask all of you, could you check right now if you've hit the subscribe button if you watch this channel regularly and you get value from what we do here? We're approaching a big milestone for Iggy in terms of subscriber numbers. So if there was one simple thing you could do to support the channel, whether you're a free viewer or paid member, it's just to hit that subscribe button and double check you've hit it. It helps us keep delivering sharper, more relevant analysis week after week. Now let us look at the Analyst Chatter. The suit view from institutional brokers is cheering the perpetual issuance as strategic refinancing that avoids diluting shareholders. But applying my filter, here is the uncomfortable truth. Calling debt equity for accounting purposes is like putting a house brand sticker on a premium product. It looks different on the receipt, but the ingredients are exactly the same. 70% gearing is simply 70% gearing, and if you want the unvarnished truth on these accounting tricks before the market opens, Iggy's elite investors get zero-day access to these exact breakdowns. Check the link below to join the inner circle. Moving to our watch list and the yield spread analysis. We have the SGX asset yield at 2.3% and the 6-month T-bill rate at 1.47%. That leaves a tiny risk premium of 0.83%. For my stress test buffer, I apply a conservative floor of 3.2% because I audit for the storm, not just the sunny day. While the T-bill sits at 1.47%, I do not lower my standards to match a temporary market dip. My floor remains at 3.2% to ensure sanctuary assets can withstand a return to long-term average interest rates. The minimum yield hurdle is 4.7%. The bottom line is about scaffolding the truth. Today's data shows a market that is deeply addicted to adjusted figures. Olam wants us to look at 0.58 times gearing instead of 2.83 times. City Developments wants us to see equity instead of 2 billion Singapore dollars in fresh obligations. The T-bill reality is stark. With the 6-month T-bill yielding 1.47%, the spread on SGX has narrowed to less than 1%. So you have to ask yourself, why take equity risk for 83 basis points of extra yield? Bringing this back to the Heartland view, let us look at the real-world impact. If you are a 50-year-old investor in Punggol managing your SRS account, SGX looks exactly like a FairPrice house brand. It is reliable, it serves a purpose, but it is definitely not exciting enough to drive portfolio growth. And for the investor in Clementi who is currently eyeing those perpetuals from City Developments, you have to ask yourself a very serious question. Is a 2.8% forward yield really worth taking on the risk of 70% corporate gearing? This brings us to a crucial rhetorical question. If a company has to call its debt equity just to keep the commercial banks happy, should you be the one left holding the bag? Accounting magic looks great on a quarterly earnings slide, but it does not fill the rice bucket. You need actual cash flow and true balance sheet strength to survive the coming cycles. If you want to stop falling for these yield traps and get the 0-day forensic analysis you need, Iggy's Elite Investors is your sanctuary. The 7-day embargo window closes fast, so click the link in the description to join the team today. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.